Well, good morning or good afternoon, depending on when you're listening to this. It's always good to be back here in Omaha, Nebraska, in my office, which hasn't changed much in, 50 plus years. People often ask me, after all these decades of doing this, what's the most important lesson I've learned? And the truth is, there isn't just one. It's a tapestry woven from successes and, frankly, a whole lot of mistakes. But if I had to pick a mistake that really hammered home a fundamental truth, it would be the one that led me to Berkshire Hathaway itself. What a bonehead move in some ways, and yet what a journey it turned out to be. Back in the 1960s, when I was running my partnership, I was always on the hunt for cheap stocks. Ben Graham, my professor at Columbia and a true giant in the field, had taught me to look for cigar butts, a company that might only have one good puff left in it, but you could buy it so cheap that the puff was free. And boy, did I find a cigar butt in Berkshire Hathaway, a dying textile mill up in New Bedford, Massachusetts. I started buying shares in 1962. It's trading at about $7.50 a share, and it had some working capital, some inventory, some machinery. The balance sheet looked like there was a dollar or two in intrinsic value per share, more than the market was giving it credit for. I thought it was a no-brainer. This was a classic Ben Graham net, a statistical bargain. Here's the deal. The company was struggling year after year, closing plants, losing money in operations, but they were using the cash from selling assets to buy back stock. The chairman at the time, a fellow named Seabury Stanton, offered to buy some shares from me at $11.50 a piece. I agreed. But then when the tender offer actually came out, it was for $11.37, and a quarter of a dollar difference. And I was mad. I was really mad. My Midwestern sensibilities were offended by what I perceived as a slight, a reneging on a verbal agreement. So I went out and started buying up more shares of Berkshire Hathaway, intending to take control of the company and fire Seabury. I ended up pouring more and more money into this lousy business. It's just out of stubbornness and a bit of a temper. What a dumb way to allocate capital. I paid good money to buy a controlling stake in a business that was doomed, just to win an argument. Charlie Munger, my partner for so many years, he laughs about it now. He says, Warren, you would have been better off if you'd just taken that 11.375 and gone to the racetrack. He was right, of course. That decision, born of petty annoyance, cost us a fortune. We poured capital into new machinery, trying to make those textile mills competitive. It was like pouring water into a leaky bucket. We tried for 20 years, from 1965 to 1985, and lost money every single year on the textile operations. Eventually, we just had to shut it down. That misallocation of capital, those 20 years of chasing a losing game, ultimately cost Berkshire something like $200 billion in lost opportunity cost. That's the difference between investing in a tight mill and investing in something like See's Candies or Coca-Cola. It was a painful, long drawn out lesson in economic reality, a stark reminder that a fair business at a wonderful price is still just a fair business. Here's what I learned from that mistake, etched into my brain by the painful reality of those textile mills. The initial investment decision, driven purely by a cheap stock price, neglected the fundamental economics of the business itself. Ben Graham taught me the importance of intrinsic value and margin of safety, and those are absolute bedrock principles. You buy a dollar's worth of assets for 50 cents, and you got a cushion. But what I failed to appreciate, and what Charlie Munger constantly pounded into my head, was that a cheap price doesn't make a bad business good. Investing, you see, isn't about buying a piece of paper. It's about owning a piece of a business. And you want to own a good business, a business with a durable competitive advantage, what we like to call a moat, something that protects it from competitors, like a castle with a wide moat. It keeps the barbarians at bay. The textile business had no moat. It was a commodity business, fiercely competitive, with no pricing power. Every year, we had to invest more just to stay in the same place, like running on a treadmill. It was an industry where capital earned low returns, and that's just a tough hand to play. So the real lesson was this: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. You want businesses that can consistently earn high returns on capital, businesses that have something that allows them to raise prices without losing customers. Think about it like this: if you own a great farm, a fertile piece of land that produces bountiful crops year after year, it doesn't matter so much if you pay a tiny bit more for it up front. Over time, that compounding productivity will reward you handsomely. But if you buy a rocky, infertile plot just because it's dirt cheap, you're going to struggle to make a living no matter how little you paid. This philosophy, heavily influenced by Charlie, fundamentally shifted our approach at Berkshire. We moved away from trying to polish turds, so to speak, and started looking for diamonds, even if they were already somewhat polished. It meant focusing on qualitative factors as much as quantitative ones: the strength of the brand, the loyalty of customers, the quality of management, the underlying economic characteristics of the industry. You don't need fancy math or complicated financial models for this. It's really quite simple. Find a business you can understand, one that has a durable advantage, and buy it when it's offered at a reasonable price. Then just sit on it. Let me give you some examples of what this shift looked like in practice. Take See's Candies. We bought See's in 1972 for $25 million. It was a company that generated about $4 million in pre-tax earnings. Now, that might sound like a lot for $25 million, but it wasn't a screaming bargain in the cigar butt sense. What it was, though, was a wonderful business. It had a strong brand in California, incredible customer loyalty, and the ability to raise prices every year without losing customers. My father, who ran a stock brokerage during the Depression, always talked about the power of a trusted name, and See's had that in spades. Charlie and I were sitting in the office when the opportunity came up. See's was generating $4 million a year on virtually no capital. They didn't need to build huge factories or spend a fortune on machinery. They just needed good candy makers and a strong brand. We could take those earnings, which were like owning a toll bridge, and deploy them into other great businesses. See's has generated over $2 billion in pre-tax earnings for Berkshire since we bought it all from that original $25 million investment. It taught us that buying a good business with a strong moat, even at a fair price, can be an incredible compounding machine. Then there's Coca-Cola. We started buying Coca-Cola in 1988. We spent $1.82 billion, and it was a significant chunk of Berkshire's capital at the time. What did we see? A simple, understandable business with an unparalleled global brand. Everyone on earth knows Coca-Cola. It has incredible pricing power. When someone reaches for a soft drink, they're not just buying sugar water, they're buying a taste, an experience, a little bit of happiness. The per capita consumption growth around the world was astounding. We understood that the world's most valuable brand being poured down billions of throats every day was going to be a very, very powerful investment. That initial $1 billion investment eventually grew to be worth well over $20 billion, not counting the huge dividends we received year after year. Another great example where we learned not just from the business, but from human psychology was American Express. Back in 1964, they had what was called the salad oil scandal. A company called Allied Crude Vegetable Oil Refining Corp., which American Express had lent money to, turned out to have tanks full of seawater instead of salad oil. American Express was on the hook for hundreds of millions of dollars, a huge sum back then. People panicked. The stock plummeted. Everyone thought American Express was going out of business. But Charlie and I, we looked at it differently. We went out and talked to people. We saw folks still carrying their American Express cards, still using their traveler's checks. The brand, the trust people had in it was immense. The crisis actually reinforced how deeply embedded American Express was in people's lives. We believed the underlying franchise was indestructible. So we started buying American Express stock, investing about $13 million, which was a huge percentage of our partnership's capital at the time. It was a contrarian move, being greedy when others were fearful. And it paid off handsomely as the company recovered, proving the enduring power of a strong brand and a loyal customer base, even in the face of a crisis. Now, look, I've made my share of mistakes even after learning these lessons. I was dumb enough to hold on to some of those losing textile investments for too long, letting pride get in the way of good business sense. I made a costly mistake with Dexter Shoes in 1993, buying it for $433 million using Berkshire stock. I issued stock for a terrible business. It was a business that required constant capital investment to stay competitive, and it simply couldn't compete with the flood of cheap imports. I missed the changing economics of the shoe industry entirely. What a bonehead move. That's a mistake that should be measured not just in the $433 million loss, but in the foregone returns of what that Berkshire stock could have achieved if invested elsewhere. That's a truly humbling thought. Then there was US Air. Back in the late 1980s, I made a preferred stock investment in US Air. It was a tempting yield, but the airline industry is notoriously difficult. That it's a terrible business with high fixed costs, intense competition, and labor issues. It's like trying to make money in a dogfight. My dad always said, if you're in a poker game and you don't know who the patsy is, it's you. I didn't fully appreciate just how much of a patsy I was being in that industry. We got out mostly whole, but it was a close call and a reminder that even a good preferred yield can't save you from a bad underlying business. So if you're a young investor today, sitting there thinking about where to put your hard-earned money, here's what I'd tell my younger self, having made all these mistakes and celebrated a few wins. The most important thing you can do is understand what you own. Don't invest in a business you can't understand. If you can't explain to a fifth grader what the business does and why it has a durable advantage, then you probably shouldn't own it. You don't need to be a genius to understand this. It's about having a simple, common sense approach. You don't need fancy math, sophisticated algorithms, or a high IQ. I've seen plenty of people with 160 IQs fail miserably in investing because they lack the right temperament. What you need is emotional stability, patience, and a willingness to think independently. The market is there to serve you, not to instruct you. It's a crazy place sometimes, swinging wildly between euphoria and despair. Your job is to ignore the noise and focus on the underlying value of the businesses you own. Remember Ben Graham's concept of Mr. Market. Imagine you own a piece of a business with a partner named Mr. Market. Every single day, Mr. Market comes to your door offering to buy your share or sell you his share. Sometimes he's euphoric, jumping up and down, offering you a ridiculously high price for your share, or demanding a crazy price for his. Other times he's depressed, suicidal almost, and he's willing to sell you his share for peanuts. The important thing is you don't have to deal with him. You can just ignore him. But if he shows up at your door with an offer that makes sense to you, either buying or selling, then you deal. Otherwise, you just go about your day. Another crucial piece of advice: develop your circle of competence. We talk about this a lot at Berkshire. Everyone has a circle, a set of businesses or industries they truly understand. Mine is pretty small. I don't invest in tech because for many years I didn't understand it. Now with Apple, that's different. We view Apple not as a tech company, but as a consumer products company with incredible brand loyalty and pricing power. People love their iPhones. They're embedded in their lives. That's a mode I understand. But generally, if it's beyond my circle, I just leave it alone. There's no rule that says you have to participate in every hot new trend. It's perfectly okay to say, I don't get it, and move on. This applies to any business, not just investing in stocks. What really matters in business is finding something that people need or want, providing it better or more efficiently than anyone else, and building a loyal customer base. Think about a local restaurant that serves great food consistently at a fair price. It builds a reputation. People keep coming back and it thrives. Compare that to a fancy new restaurant that's all hype, but inconsistent quality. It might get a lot of buzz initially, but it won't last. Longevity in business, whether you're buying a stock or running a lemonade stand, comes from providing enduring value. The quality of management is also paramount. Charlie and I look for managers who are honest, intelligent, and energetic. Honest because you want them to treat your capital as if it were their own. Intelligent because you want them to make good decisions. And energetic because you want them to put in the work. You can teach a smart person a lot, but you can't teach character or innate drive. Over at Berkshire, we've been incredibly lucky to have phenomenal managers like Ajit Jain in our insurance operations and Greg Abel, who is overseeing our non-insurance businesses. They run their businesses like they own them. And that's the kind of management you want backing your investments. But that's not the only lesson I learned the hard way. This reminds me of another time when I let emotion, or rather, the lack of careful analysis, lead me astray. It's about the power of focus and the danger of dilution of attention. Back when I was a young fellow delivering newspapers in Omaha, I learned the value of every penny. I saved every single one. My dad taught me about being fro, and that stuck with me. When I filed my first tax return at age 13, I remember deducting my bike and watch as business expenses. I was always thinking about how to make a dollar grow. I bought my first stock, City Service Preferred, at age, it was $38 a share. And then it dropped to $27, which scared the heck out of me. When it finally got back up to $40, I sold it for a small profit. And then, would you know it, had shot up to 200. That taught me a different kind of lesson, patience, and not to jump out of a good stock too early. But it also fed into a habit I had for a while of buying a little bit of this, a little bit of that, looking for any undervalued situation. In those early days of the partnership from 1956 to 1969, I was buying little pieces of dozens of companies. It was a cigar butt approach on steroids. I was looking for anything that traded below its intrinsic value, no matter how small the discount. We'd buy it, we'd wait for it to go up a bit, and we'd sell. It worked, don't get me wrong, we compounded capital at something like 20% a year, crushing the Dow. But it was a lot of work, and it meant spreading our attention across a vast number of mediocre businesses. Charlie, again, was the one who helped me see the light. He always says, you don't get rich by buying a little bit of everything. You get rich by putting your eggs in one basket and watching that basket very carefully. He taught me the power of focus and how concentrating capital in a few truly outstanding businesses rather than diversifying across many merely good or fair ones yields far superior results. It's better to understand a few things really well than to superficially understand many things. Think of it like this. If you have a great idea for a business, a product or service that genuinely stands out, would you want to put a tiny bit of your money into it and then put most of your money into 50 other average ideas? Of course not. You want to load up on your best idea. The same applies to investing. Our top holdings at Berkshire, like Apple or Coca-Cola or American Express, are where we have significant capital. We understand those businesses and we believe in their long-term prospects. We don't diversify just for the sake of it, because that often means diversifying away from your best ideas. This leads me to another core principle, compounding. Albert Einstein, or so the story goes, called compound interest, the eighth wonder of the world. And it truly is. Starting early and letting your money grow over decades is the most powerful financial force there is. My dad taught me to save early. I remember my paper route earnings. I took every penny and put it to work. If you start saving and investing a modest sum consistently when you're young, even $100 a month, and let it compound for 40, 50, 60 years in a good business or a low-cost index fund, you will end up with a substantial amount of money. The key is patience. The market doesn't reward activity, it rewards intelligent inactivity. You don't need to do extraordinary things to get extraordinary results. Just consistently apply sound principles, avoid foolish mistakes, and let time do the heavy lifting. Our favorite holding period at Berkshire is forever. We want to buy a business and never have to sell it. That's how compounding really works. That's magic. Of course, a big part of avoiding foolish mistakes is avoiding debt. I've never borrowed significant money personally, nor has Berkshire for its investments. We operate with a huge safety margin. Debt is a powerful tool, but it's also a dangerous one. It can magnify your returns, but it can also magnify your losses and wipe you out entirely. When you borrow money to invest, you're essentially betting that the future will unfold exactly as you predict and that the market will cooperate. History teaches us that the market can be unpredictable, and Murphy's Law usually finds a way to surprise you. A healthy respect for risk and a healthy disdain for unnecessary debt will serve you well. A shareholder once asked me at our annual meeting, we get 40,000 people showing up in Omaha these days, a truly remarkable gathering. What's the best investment I can make? My answer is always the same. Invest in yourself. Improve your communication skills, learn more, read more. I spend 5 to 6 hours a day reading. Annual reports, 10Ks, newspapers, biographies, history books. I just read and think. It's how I build my knowledge base, how I identify good businesses, and how I learn from the mistakes of others. The more you learn, the more you earn, not just in money, but in understanding the world around you. You know, people think you need some complicated formula or inside information to be successful in investing, but actually it's quite the opposite. The vast majority of what I do is available to anyone. My annual letters to shareholders, which I write myself, are packed with the principles we follow. It's all out there in plain sight. What it takes is discipline, patience, and a willingness to do a bit of homework. Look, I still live in the house I bought in 1950. I drive myself to the office every day. My diet consists mostly of Cherry Coke, See's Peanut Brittle, Dairy Queen, and McDonald's. It's not about extravagant spending or complex living. It's about clear thinking and consistent application of a few basic principles. Human nature, though, is the trickiest part. People often let their emotions guide their investment decisions. They buy when everyone else is buying, when prices are high, driven by greed, and they sell when everyone else is selling, when prices are low, driven by fear. Charlie always tells me, be fearful when others are greedy, and greedy when others are fearful. It sounds simple, but it's incredibly hard to do when the whole world seems to be going one way. It requires an independent mind and the courage to stand apart from the crowd. The dumbest reason to buy a stock is because it's going up. That's speculation, not investing. Investing is about owning a piece of a business, understanding its value and letting that value compound over time. It's about asking yourself what the business is really worth, the intrinsic value, and then waiting for the opportunity to buy it at a discount. If you just buy because the chart looks good, you're playing a game. You're unlikely to win. Price is what you pay, value is what you get. Never forget that.
I'm 94 now, and if I could tell young investors one thing, it would be this. Time is your friend. Start early, live below your means, and invest consistently in a diversified, low-cost index fund if you don't have the time or inclination to pick individual stocks. You don't need to be brilliant. You don't need inside information, and you don't need to check stock prices every day. What you need is a solid temperament, the ability to control your emotions, and the discipline to stick to a simple long-term plan.
After all these years of doing this, here's what I know for certain. America is an incredible country. I'd never bet against America. The inventiveness, the resilience, the free market system, it creates enormous wealth over time. Your job is to simply participate in that growth patiently and intelligently. Don't listen to the talking heads on TV who are trying to get you to trade constantly. Ignore the daily fluctuations of the market. Focus on building and owning great businesses for the long haul. Rule number 1, never lose money. Rule number 2, never forget rule number 1. What that really means is Protect your capital, be prudent, understand the risks. A high return achieved with high risk is no bargain. Focus on what is knowable, what is understandable, and what is durable. The rest will take care of itself. And remember, investing is far more about temperament than it is about intellect. Find a few wonderful businesses, buy them at fair prices, and just let them work for you year after year. That's how fortunes are really built.